The system did not fail. The alert was delivered. It was categorized as low priority. It appeared once, on April 3rd, at 9:12 a.m. No trade malfunctioned. No fraud occurred. No account restriction was applied. But over the next 73 days, one portfolio declined steadily. Not suddenly. Not dramatically. Quietly. By June 14th, the unrealized loss reached $42,800. The warning had been visible the entire time. The portfolio was structured for balanced growth and moderate ROI stability. Allocation: 60% diversified equities, 25% index funds, 15% speculative growth exposure. Rebalancing was scheduled every Friday at 4 p.m. Automated alerts were enabled for volatility spikes, sector concentration shifts, and drawdown thresholds exceeding 8%. All systems were operational. On April 3rd, volatility in the technology sector increased beyond its normal deviation range. The system flagged it. Severity: minor. No manual escalation followed. The brokerage platform monitored sector concentration daily. If a single sector exceeded 35% of total allocation, a caution notice appeared in the dashboard summary. This safeguard existed to prevent silent overexposure. On April 5th, technology allocation rose to 36.4%. The alert indicator turned amber. No rebalance order was executed. Diversification appeared intact on the surface. Technology had outperformed for 11 consecutive months. Previous pullbacks had reversed within days. Historical performance influenced present judgment. The assumption was simple: recovery was likely. From April 5th to April 16th, no manual review occurred. No reallocation. No reduction in position size. During this period, technology exposure climbed to 41%. One ETF inside the portfolio had adjusted its internal weighting. It increased allocation toward a single AI-driven semiconductor firm. The adjustment was disclosed in its monthly report. The report was not reviewed. On April 26th, the portfolio crossed the 8% drawdown threshold. An automated email was sent at 3:02 p.m. Subject line: Portfolio Threshold Notice. The broader market was experiencing earnings season volatility. The decline did not appear extreme. The assumption was temporary weakness. The login did not occur. 7 trading sessions passed. The broader index stabilized. The concentrated holdings did not. Correlation risk increased. Beta exposure moved outside target range. A stop-loss feature was available for speculative assets. It had never been activated. By May 4th, speculative allocation exceeded 18%. The internal cap had been 15%. The breach appeared in red text within the dashboard summary. No adjustment followed. There was no crash. No headline crisis. Just persistent underperformance. Over 19 additional trading sessions, gradual erosion continued. Each day small. Collectively significant. A portfolio review meeting had been scheduled for April 10th. It was postponed due to a scheduling conflict. No new date was set. Without structured review, automation became passive observation. Automation identifies. Humans intervene. Intervention did not occur. On June 14th, the semiconductor firm at the center of the ETF reduced forward revenue projections. The stock declined 14% in a single session. Because sector concentration had already exceeded limits, the portfolio absorbed amplified impact. By market close, the unrealized loss reached $42,800. 73 days earlier, when the first volatility alert appeared, projected exposure loss stood near $6,400. The difference was not caused by a single event. It was caused by accumulation. Volatility alert triggered. Sector concentration threshold displayed. Drawdown notice delivered. Speculative cap breached. Stop loss available. No safeguard malfunctioned. The missing variable was response timing. Small alerts often carry delayed cost. Minor oversight compounds through inaction. Investment mistakes rarely begin with collapse. They begin with classification. If you manage investments, consider a procedural response structure. Review minor alerts within 24 hours. Audit sector concentration weekly. Check ETF composition monthly. Activate stop-loss limits for speculative exposure. Document every postponed review meeting. Set a mandatory response rule for drawdowns exceeding 8%. Automation cannot replace accountability. Portfolio oversight requires scheduled intervention. ROI stability depends on timing discipline. Revisit the timeline. April 3rd, volatility alert logged. April 5th, sector concentration exceeded threshold. April 10th, review meeting postponed. April 26th, drawdown threshold crossed. May 4th, speculative cap breached. June 14th, forward guidance revised downward. No single day destroyed the portfolio. Each day contributed. The first alert was categorized as minor. It remained categorized that way in perception. That classification persisted. By the time exposure was reduced, recovery required disproportionate market growth. Capital preservation had already been compromised. Nothing dramatic occurred. No emergency signal. No account restriction. Just delayed attention. There was one additional detail. The April 3rd alert had been opened. System logs showed it was viewed for 11 seconds. No action followed. If this were your portfolio, at what point would you have intervened? April 3rd. April 5th. April 26th. Or June 14th. Comment the exact date you would have acted, and explain your reasoning. Your response may help someone else prevent a similar loss. Small decisions shape financial outcomes. And most losses begin quietly.